Welcome back. And now I'm so excited to go over with you a very important lesson. It is what is LE? LE stands for loan estimate. Okay, and what is LE? Before I read you the definition of loan estimate, I would like to tell you a story, a real story. I had a privilege to serve one of my clients who is a very hardworking person. He earned W-2 income, meaning he have fixed income. He doesn't have commission, he doesn't have overtime or bonus. He have a really fixed income, and he have 10% down payment as a first-time home buyer. 10% down payment is a huge number to me. So he really worry about his monthly payment and how much money he need to have in order to buy his first home. And he was really worried. He expressed how worried he is to me. So I invited him to sit down with me. We go over a loan estimate because the loan estimate would show him all the points, the costs, and the estimated interest rate, where he can see, kind of know how much he had to pay each month and how much is his closing costs, so that he prepare enough money to buy the properties. So after we go over the loan estimate, he was a lot more confident and feel like I can do it, right? So I kind of tell you what a loan estimate is, but I'm still reading you the definition of loan estimate. So loan estimate is a three-page form, right? And normally you will receive a loan estimate within 3 days after lender receive your loan applications. Loan estimate include interest rate, estimated interest rate, because you haven't locked the rate yet, so you have an estimated interest rate, estimated monthly payment, and it includes points and costs. All the money you have to come up with to close the transaction. The purpose of a loan estimate is to provide a consumer with a uniform document that is easy to compare one lender's offer versus another. And now I would like to introduce to you the loan estimate. You can look on your screen, there is a loan estimate. You see this? At the top of the screen, there is the name of the lender, in this case a funding corporation, right? And then you see underneath there's a date issue of the loan estimate, and then the applicant names and the property address and sale price. In this case, the sale price is $440,000. On the other side is a loan term of 30-year fixed. Purpose is the purchase transaction. Products, the client want a fixed interest rate. And you see loan type, in this case conventional loan, right? Loan number ID. Every loan have a number associated with it. A rate lock, in this case you see the check mark check on the no. That means we haven't locked the rate yet, right? And then further down you see the loan terms. Loan amount in this case is $330,000, and interest rate is 4.875%. It is an estimated interest rate, right? And then monthly principal and interest, that means monthly mortgage payment in this case is also an estimated number, $1,746.39. Prepayment penalty in this loan, this particular loan, there is a yes, there is a prepayment penalty, but not every loan have prepayment penalty, right? Balloon payment is a no. Normally nowadays there is no balloon payment type, right? Especially when you do conventional loan or government loan, there is no balloon payment. And I want to go over the no next to the loan amount, and the no next to the interest rate, and the no next to the monthly mortgage payment. Meaning after we close the transaction, that means after the buyer bought the home and become the new owner, these number, the interest rate, the loan amount, and the monthly payment cannot change. But these number will change during the process of doing the loan, but it won't change after the loan is complete, right? And down below you see the projected payment. The projected payment, it shows the principal interest, the same number at about $1,746. In this case, mortgage insurance, no, zero, and estimated escrow, zero mortgage insurance because somebody have more than 20% down payment, they don't have to pay mortgage insurance. But anyone who have less than 20% down payment, there is a mortgage insurance, okay? And down below we have estimated tax, insurance, and assessment, meaning $493. It would include property tax and insurance, monthly property tax and insurance, okay? You see at the same row with estimated tax, insurance, and assessment, it say in escrow, no, meaning the client doesn't want to pay property tax and insurance together with the monthly mortgage payment. Instead, the borrower will pay the property tax twice a year by himself or herself and paying the insurance once a year by himself or herself, okay? If somebody want to pay property tax and insurance together with their monthly mortgage payment, they will have what called impound account or escrow account. That's something else. In this case, it doesn't apply, so this borrower will pay the monthly mortgage payment by itself, and he or she will pay the property tax twice a year and the insurance once a year. And at the very bottom, you see costs at closing. This is very important, and you will see the estimated closing cost right here at $14,885, and estimated cash to close is $123,260. Normally, people, most of the time, as a home buyer, you will look at this two number, right? Because you worry about how much I have to have. Do I have enough money to bring in to get it done? So you look at this two number and you wonder, how do we come up with $14,885? How do we come up with $123,260? In order for us to know how to come up with these two numbers, we'll have to go to page 2 of the loan estimate. And page 2 of the loan estimate is where all the breakdowns occur. And this page is the most important page in the 3 page of the loan estimate. We will go over line by line of page 2 of loan estimate in the next lesson. But right now, I just want to introduce to you how it looks. So you see the second page, there are 3 columns. One on the, I'm going to show you this. The one column on this side, it's a loan cost. It's one column loan cost and the other one in the other cost. Remember, loan cost in one side, other cost is another side. Okay? So we will look at them in detail later on. Now I'm going to introduce to you the 3rd page of the loan estimate. And the 3rd page will be the more like a summary of the 1st and the 2nd page. So look at page number 3. You see page number 3, it say in 5 years. In 5 years, total you will have pay in principal, interest, mortgage insurance, and loan cost is $117,158. So that after 5 years, the total number $117,155 include your principal, interest, mortgage, and then mortgage, insurance, and loan costs. Everything you have been paying so far, like since the day you close the transaction to 5 years later. That's how much you pay for this loan if you lock the rate at 4.875. And also, the $27,507 is the principal you have paid off. So the loan amount at the beginning, when the client get the home, they borrow a loan of $330,000, right? After 5 years, the principal go down by $27,000. So the loan amount maybe at that time only $303,000. You see what I'm saying? Because they pay down $27,000 in principal. So the loan amount is shrink down from $330,000 to $303,000. Okay. So this is more like a summary page, and And the last one would be interesting. It said total interest percentage in 90.9%. What does it mean? If the client keep this loan, right, for 30 years, every month paying the same payment with the interest rate of 4.875, by the year 30, like after 30 years, she pay off the mortgage. Her loan amount is 330, right? Let me see, 330,000, 90.9%. So 330,000 times 90%. She paying 297,000 interest to this loan. So 30 years later, this client paying almost 300,000 interest for her mortgage. You might think, wow, that's a lot of money. But listen, if you keep your home after 20 years, your home appreciate more than 400%. So even this borrower paying almost 300,000 for the mortgage, but her home value at that point after 30 years is way different. Let's go back to the past. I have many clients who bought home 30 years ago for $100,000. Now their home is $1.9 million. So if she or he buying a 100,000 home by paying 100,000 interest, so total paying 200,000, but now the home value almost 2 millions. So it doesn't matter what the interest rate is. This client still makes so much money because the home appreciation so much. The home appreciation beats all the interest rate, beat all the inflation. So as long as someone invests in real estate, knowing they make money, okay. So I think that is it for the 3-page of the loan estimate. So congratulations, you just done with the one lesson about loan estimate, but we are going into the next lesson. I'm so excited to go over lesson number 2. It's going to be a lot more details, but you're going to learn so much. It's going to be about page 2 of the loan estimate. Okay, see you in the next lesson. Hey, hello. Okay, welcome back. Lesson about loan estimate, page number 2, but this time we're gonna go over detail, break everything down in smaller section so you can understand everything really well. So first of all, I want to give you a definition of what is mortgage point. A lot of time you might have heard points and cost, but there are different points. There are different types of mortgage points. Today we talk about 2 different mortgage points. The first one is the discount points. The second one is the origination point. Origination points also called origination fee. So origination fee or origination points are points that are paid to lender for creating the mortgage. So basically, the lender or the mortgage broker get commission by the origination points or fee, right? And the discount points is the points that are paid to the lender to lower the interest rates. So when the borrower or the buyer want lower interest rate, they will say, I want lower interest rate. How much do I have to pay for the points? So that's the discount point they talk about when they want lower interest rate. So you see the difference between the two, right? The discount point is to pay for your lower interest rate, but the origination point is to pay for the lenders or the mortgage broker for originate the loan for you. That means when you need a loan, someone help you with a loan, they get to earn the origination points. All right, now we take a look at the number in the loan estimate. So when you look into the number right here, you see remember in the page 2 of loan estimate, there are two columns. One column is loan cost, the other column is other costs. And I crop one column out to show you, and this is the loan cost column. And this loan cost column, you see there are, I named them, each section is named with a letter. So the first section, I name it with the letter A, and then the second section, I name it a letter B, and the last section there, I name it letter C. Later on, I will introduce to you another section, letter D, in the loan cost section, but right now, let's look at A, B, and C. But for the purpose of learning about the mortgage points, we're going to look at only section A right now. And if you see section A, you see two numbers in there, right? The first one, the first line, percentage of loan amount points, that doesn't have any number. And that is the discount point. If somebody want to lower interest rate, they want to pay the discount point, it should show the number there. In this case, for this loan estimate, we don't see the discount point, meaning at this stage, the borrower didn't anticipate to pay any discount point. So there is no discount point. But there is origination points or origination fee right underneath, $5,775. That's the origination points that the borrower paying for the mortgage broker or the lender who originate this loan, right? And that, so you see that, you see there is no discount point, right? There is no discount point, but there is a origination point. Okay, so you just learn section A, how to find discount point, origination point, and okay, one more thing I want to show you in this section is the underwriting fee. So you see underwriting fee, the amount is, what do you see? Did you see it? $1,494. You see the underwriting fee. And what is underwriting fee, right? Underwriting fee is used to pay the lender to cover their overhead and administrative costs. Okay, so beside the origination fee, beside the discount point, you will also find the underwriting fee in section A. All right, so you now know exactly where to find origination fee, discount points, and underwriting fee. It in section A. Okay, so I will see you in the next section. We'll learn about section B. So what is in section B? And C in the loan cost column. See you then. Bye. Hello, welcome back. Okay, now we are looking at the whole column of loan cost. So we already looked at section A because there are three sections in the loan cost column, A, B, and C. We looked at A already. In A, we see origination fee, discount points, and underwriting fee. Now we look at section B and C. In section B, there are appraisal fee, credit report fee, tax service fee, and flood certification. So appraisal fee, why do we have to pay appraisal fee? Because lender, they don't go to your house and look at your house and find out the condition of the home and how much the home worth. So they hire another company called appraisal company, and the appraisal company assign an appraiser to come to the house that you are buying or refinance to look at the house, taking picture, write up a report regarding to the home condition and how much the home worth, and send it to the lender. That's when lender review the appraisal report. Appraisal report is really important document that lender want to see. And then of course the buyers or the borrower have to pay for the appraisal report fee. Okay, and it normally costs from around $500 to $750 each report. And the credit report fee also, a mortgage broker or a lender, we don't own any database. There is a company that create a database keeping track of all your payments, your history payment of all your debt, your liabilities. So when we run credit report to find out your credit scores and your credit histories, we have to use a database from a company that provide the database. And because they provided the data, we have to pay for them. So the consumer, meaning the buyers or the borrower, have to pay for the credit report, and it costs about $35 per report, right? Flood certification. Every time when lender about to let you borrow the money, they want to find out if your your house is sitting on the flood zone or a non-flood zone area. And in order to do that, they run your home address through a database to find out if this area is a flood zone area or no. If it is in flood zone, lender will require a borrower or the buyer to buy flood insurance. If the home is not in the flood zone, you don't have to buy flood insurance. Flood insurance is really expensive. No one want to buy flood insurance, okay, unless the home is in the flood zone. And tax service fee is the fee that we have to pay to the third party, that companies watching us as a homeowner to see if we pay our property tax or not, right? If we don't pay our property tax, that company, the tax service fee company, they will let the lender know, and the lender say, hey, you have to pay your property tax. Also, the county will knock your door if you don't pay their property tax, right? So somebody always watching us if we don't pay our property tax. So be careful. So that all the fees, those are the fees in Section B, and those are the fees as a buyers or the borrower, we have to pay for it. And now we look into Section C. Section C, it includes all the fees that title and escrow company charge the buyers, right, the borrowers. We would say, who is title? Why do we need a title and escrow company? It's really simple. We need someone to take care of us, like someone to protect us. So as a buyers, we get to be, protected by title and escrow company. Title and escrow company is a third neutral company. This company is watching lender documents, seller documents, buyer document. They look at all the document to see that everybody doing the right things, right? If somebody doing the wrong thing, there's a red flag, and they will gonna say, hey, this is not right. Let's do the right thing, right? And also the title company make the buyers to pay for, in this case, you have to pay for lender title policy. When you borrow a mortgage, you have to pay lender title policy. And you also have to pay for owner policy. We'll talk about owner policy later. But anyway, the title company is there to watch all parties that involved in a real estate transaction, make sure everything is correct, right? So that all the fee, you will find all the escrow fee and title fee in Section C. And when we add all the number in Section A, all the number in Section B, all the number in Section C, A, B, and C, all the number together, we have the total number, and that total number is the loan cost, and we name it the D, okay? So D is our total loan cost, okay? Now you finish lesson 4 of module 1. Are you happy that you've been up all the way to this point? You kind of, yeah, oh, I see, this is easy, this is simple. Yes, after you learn it, everything is so easy, right? Congratulations, you already finished lesson number 4. You halfway of module 1. I'll see you in the next lesson. Hello, welcome back. Congratulations, we are now in lesson 5, module 1. So we are now looking at other costs. Remember, page 2 of loan estimate? There are 2 columns. One is loan cost and the other one is other cost. We already look at all the loan cost number. Remember A, B, and C, and then we add them up, we have D. That the total loan cost is D. We name it. We name them, okay? Now we look at the other cost. Other costs we also name them by section, so it's easier to talk, right? So we have E section, F section, G section, H section, and then I and J. We have more letters this time. So in the E section, we have recording fees and transfer tax. What are recording fees? Okay, recording fees are the fees we have to pay to the county where we live, or where the property is. Not where we live. For example, if you buy a property in county of Santa Clara, you have to pay the recording fee to the County of Santa Clara. Why? For example, when we purchasing a home, and at the moment we become the new owner of the properties, now we need to let the county know I'm now a new owner, so that's how to do that. We have to swap name. The new owner will be replace the previous owner. So your name now will be on the record of the new owner of the home, not the previous owner. So the process of swapping name, putting your name as a new owner, it's called recording. They record your name as a new owner at the county. Okay, so you have to pay the recording fee to the county. That's why. And there is a transfer tax. By the way, if you do, even when you do refinance, there is no, when you do refinance, you don't change name on owner, no name change on ownership. They still have to do recording because they are changed in lender, right? Lender, when we refinance, meaning we change lender. When we change lender, we also need to record that new lender to the county. So the county will show your home record, and underneath your home, there is a lender, and it has to be the new lender name. Okay. Now we talk about transfer tax. In Section E, there is a transfer tax. What is transfer tax? Whenever there is a change in ownership, there is a transfer tax. For example, whenever you buy a home and you become the new owner, they change the owner name from the previous owner out of the title, and you are the new owner, your name will be on the title. And at the moment your name change on the title, there is change in ownership, and there is a transfer tax, right? And when you do refinance, sometime there is a transfer tax when there is a change in ownership. For example, originally husband and wife on title of the home, but at the time of refinancing, they want to add one of their children in title, maybe a son who is over 21 years old on title. So after refinancing, there are 3 people on the loan and on the title. So husband and wife and a son. Now the title was 2 people, now 3 people, that there is a change in title. And in this case, there is a transfer tax, right? And whenever there is a change in ownership, there is a transfer tax, and there is a change in property tax, okay? That we will talk in another separate section, but right now we don't talk about property tax, but we will talk about there is a transfer tax when there is a change in ownership, okay? So that's Section E, there is transfer tax and recording fee. And in the F section, you will see the 12-month home insurance premium, and then the mortgage insurance premium. If there is, in this case, there is no mortgage insurance because the borrower have 25% down payment, there is no mortgage insurance. There are cases when there is mortgage insurance. Either you do a FHA loan, you have to pay mortgage insurance, monthly mortgage insurance, and upfront mortgage insurance. Or when you do conventional loan with less than 20% down, you will have mortgage insurance. Of course, there are situations when you do the lender pay mortgage insurance, then you don't see yourself paying mortgage insurance, but actually you do pay it because the rate is higher. But anyway, in this case, there is no mortgage insurance because this client is doing a conventional loan with 25% down, so there is no mortgage insurance, okay? Prepaid interest, in this case, it's $44 per day. This is an estimate, but we will go over this section more in the closing disclosure. Right now, it's an estimate. I just introduced to you what in the Section F. So if there is, there is a property tax, if there is something that you need to pay there. So in Section F, it's more like insurance, property tax, and mortgage insurance. That's where the number you need to find out, right? And Section G is about also the same thing, mortgage insurance and property tax. It's more like an escrow impound account. So we'll talk about that later. Right now there's nothing in there to talk about. In the H section, owner title policy, $1,141. In the H section, this is important to know. You only see the owner title policy when you are in a purchase transaction, when you do a loan, when you buy a property. You don't see owner title policy when you refinance. Why? Because owner title policy is actually protecting the buyers. In case, let me read the definition for you. It's actually right here. Owner title insurance provide protection to the homeowner if someone sue or say they have claim against the home from before the homeowner purchases. What does it mean? It means, okay, you buying a home, right? And the owner title policy would protect the buyer by looking to see if the properties and the previous owner have any liabilities lien on the property. If there is any lien on the property, the title and escrow company will make the seller pay all that liabilities before he transfer his home to you as a new owner. If the owner have liabilities lien on the home but no one knows, even the title company didn't know or escrow company didn't know, and you move into the property, become the new owner of the home, and then a year later there's a letter come to your house make you paying for the previous owner liability or a debt, what happened is you can go back to the title company and say, hey, this debt or liability belong to the previous owner, not me. Then the title company will be the one who pay for that liability or the debt, because they didn't do a good job of searching to see if there is any liabilities or debts belong to the previous owner lien on that home. Because they didn't do a good job, they have to pay for it. And then after that, they can go after the previous owner and get back the money or whatever they're doing. It's the title company issue. But the whole point here is, when there is an owner title policy, the new owner or a buyer is protected. Okay, you don't have to be liable for the previous owner liability or debts that lien on the home. So make sure when you purchase a home, you want to see the seller pay for the owner title policy, because it protects you, a home buyer and a homeowner. Okay, let's take a look at I. Section I is the total of all the section E, F, G, H. When you add E with F with G and H together, you have a total number, and that is I. So I just a total number of the other costs. But look at J. There is a J column. So again, I is the total number of the other costs. Everything in the other costs column. What is J? J is the total number of the two column, loan costs plus the other costs, equal to J. So now, but in the J section, you see the lender credits. If there is the lender credits, we have to take that into account. In this case, there is no lender credits, so we don't see anything. We only see that in this section, the J section, J equal to D plus I. J equal to D, remember D is the loan cost, the total loan cost, D, and now I is the total other cost. So J equal to D plus I, and D is the total loan cost, I is the total other cost. Alright, so in this case, when we add D and I together, we have the $14,885. Don't worry, we're gonna go over each number very soon in the next section. So now you just finished lesson number 5. We're gonna go to lesson number 6, seeing all the breakdown very soon. You almost there. Congratulations, we almost done with module 1. Oh my goodness, you already section 5. We're going to go to next section, section 6. See you in the next section. Hello, welcome back. Congratulations, we are now in lesson 5, module 1, So we are now looking at other costs. Remember, page 2 of loan estimate, there are two columns. One is loan cost and the other one is other cost. We already look at all the loan cost number. Remember A, B, and C, and then we add them up, we have D. That the total loan cost is D. We name it, we name them, okay? Now we look at the other cost. Other costs have, we also name them by section so it's easier to talk, right? So we have E section, F section, G section, H section, and then I and J. We have more more letters this time. So in the E section, we have recording fees and transfer tax. What are recording fees? Okay, recording fees are the fees we have to pay to the county where we live or where the property is. Not where we live. For example, if you buy a property in County of Santa Clara, you have to pay the recording fee to the County of Santa Clara. Why? For example, when we purchasing a home, and at the moment we become the new owner of the properties, now we need to let the county know I'm now a new owner, so that's how to do that. We have to swap name. The new owner will be replace the previous owner. So your name now will be on the record of the new owner of the home, not the previous owner. So the process of swapping name, putting your name as a new owner, it's called recording. They record your name as a new owner at the county. Okay, so you have to pay the recording fee to the county. That's why. And there is a transfer tax. By the way, if you do, even when you do refinance, there is no, when you do refinance, you don't change name on owner, no name change on ownership. They still have to do recording because they are change in lender, right? Lender, when we refinance, meaning we change lender. When we change lender, we also need to record that new lender to the county. So the county will show your home record, and underneath your home there is a lender, and it has to be the new lender name. Okay, now we talk about transfer tax. In section E, there is a transfer tax. What is transfer tax? Whenever there is a change in ownership, there is a transfer tax. For example, whenever you buy a home and you become the new owner, they change the owner name from the previous owner out of the title, and you are the new owner, your name will be on the title. And at the moment your name change on the title, there is change in ownership and there is a transfer tax, right? And when you do refinance, sometime there is a transfer tax when there is a change in ownership. For example, originally husband and wife on title of the home, but at the time of refinancing they want to add one of their children in title, maybe a son who is over 21 years old on title. So after refinancing, there are 3 people on the loan and on the title. So husband and wife and a son. Now the title was 2 people, now 3 people, that there is a change in title. And in this case, there is a transfer tax, right? And whenever there is a change in ownership, there is a transfer tax and there is a change in property tax, okay? That we will talk in another separate section, but right now we don't talk about property tax, but we will talk about there is a transfer tax when there is a change in ownership, okay? So that's section E, there is transfer tax and recording fee. And in the F section, you will see the 12-month home insurance premium, and then the mortgage insurance premium. If there is, in this case, there is no mortgage insurance because the borrower have 25% down payment, there is no mortgage insurance. There are cases when there is mortgage insurance. Either you do a FHA loan, you have to pay mortgage insurance, monthly mortgage insurance, and upfront mortgage insurance. Or when you do conventional loan with less than 20% down, you will have mortgage insurance. Of course, there are situations when you do the lender pay mortgage insurance, then you don't see yourself paying mortgage insurance, but actually you do pay it because the rate is higher. But anyway, in this case, there is no mortgage insurance because this client is doing a conventional loan with 25% down, so there is no mortgage insurance. Okay, prepaid interest in this case is $44 per day. This is an estimate, but we will go over this section more in the closing disclosure. Right now, it's an estimate. I just introduced to you what in the section F. So if there is a property tax, if there is something that you need to pay there. So in section F, it's more like insurance, property tax, and mortgage insurance. That's where the number you need to find out, right? And section G is about also the same thing, mortgage insurance and property tax. It's more like an escrow impound account. So we'll talk about that later. Right now, there is nothing in there to talk about. In the H section, title, owner title policy, $1,141. In the H section, this is important to know. You only see the owner title policy when you are in the purchase transaction, when you do a loan, when you buy a property. You don't see owner title policy when you refinance. Why? Because owner title policy is actually protecting the buyers. In case, let me read the definition for you. It's actually right here. Owner title insurance provide protection to the homeowner if someone sue or say they have claim against the home from before the homeowner purchases. What does it mean? It means, okay, you buying a home, right? And the title, owner title policy would protect the buyer by looking to see if the properties and the previous owner have any liabilities lien on the property. If there is any lien on the property, the title and escrow company will make the seller pay all that liabilities before he transfer his home to you as a new owner. If the owner have liabilities lien on the home, but no one knows, even the title company didn't know or escrow company didn't know, and you move into the property, become the new owner of the home, and then a year later there's a letter come to your house make you paying for the previous owner liability or a debt, what happened is you can go back to the title company and say, hey, this debt or liability belong to the previous owner, not me. Then the title company will be the one who pay for that liability or the debt, because they didn't do a good job of searching to see if there is any liabilities or debts belong to the previous owner lien on that home. Because they didn't do a good job, they have to pay for it. And then after that, they can go after the previous owner and get back the money or whatever they're doing. It's the title company issue. But the whole point here is, when there is an owner title policy, the new owner or a buyer is protected. Okay, you don't have to be liable for the previous owner liability or debts that lien on the home. So make sure when you purchase a home, you want to see the seller pay for the owner title policy, because it protects you, a home buyer and a homeowner. Okay, let's take a look at I. Section I is the total of all the section E, F, G, H. When you add E with F with G and H together, you have a total number, and that is I. So I just a total number of the other costs. But look at J. There is a J column. So again, I is the total number of the other costs. Everything in the other costs column. What is J? J is the total number of the two column, loan costs plus the other costs, equal to J. So now, but in the J section, you see the lender credits. If there is the lender credits, we have to take that into account. In this case, there is no lender credits, so we don't see anything. We only see that in this section, the J section, J equal to D plus I. J equal to D. Remember, D is the loan cost, the total loan cost. D, and now I is the total other cost. So J equal to D plus I, and D is the total loan cost, I is the total other cost. All right. So in this case, when we add D and I together, we have the $14,885. Don't worry, we're gonna go over each number very soon in the next section. So now you just finished lesson number 5. We're gonna go to lesson number 6, seeing all the breakdown very soon. You almost there. Congratulations, we almost done with module 1. Oh my goodness, you already section 5. We're going to go to next section, section 6. See you in the next section. Hello, welcome back to module 1, lesson 7. Oh my goodness, you almost done with module 1. And in this module, good news, there is no new concept, no new anything. It's about a quiz. We created the quiz just to make sure that you remember what you just learned in the previous lesson, right? And the quiz will be very easy and simple, and it might be a little bit silly. You might laugh at how we create a quiz, but the whole purpose is to make you have some fun, and because we want you to learn this in a happy way, enjoying it, happy learning, right? So I want to remind you how to read a loan estimate. Go to page number 2 and look into it into small section. You know, when you eat a piece of cake, you eat one bite at a time. It's much easier than you eat the whole entire piece one time and with mouthful, right? It's same thing when you read the page 2 of loan estimate. I want you to break it into pieces and read it. So look at page 2. There are 2 sections: loan costs in one column, other costs in another column, and in each column you break it into smaller section. In the loan cost, you break into A section, B, C, and D, and in the other cost, you break it into E, F, G, H, I, and J section. So that's really easy. So and remember, the total closing cost is the total loan cost added up with the total other costs. Remember that? So now let's take a look at the quiz. So you see, I'll ask you 4 questions. So the first question, what does LE stand for? It's so easy, right? And there are 2 answers right underneath it. You need to select one, and I know you're gonna select a correct answer. And the second question is total closing costs equal to loan cost plus other cost. True or false? I know you know the answer too. And then the third question is the total closing cost is not the same as cash to close. So obvious, right? And I know you're gonna click on the right and correct answer. I know you do. And the last question is cash to close equal to total closing cost plus down payment minus seller credits. And you will also select the correct answer. I know for sure. So I hope you enjoyed the lesson, and I know you've been learning so much. I'm so happy for you, and I can't wait to see you in the next lesson. By the way, you almost done with module number 1. See you in the next video. Hello, congratulations! You just finished module 1, and you know I'm just here to congratulate you, and you just finished the hardest, longest module in the whole entire master class. I know you are so much more confident now. If you are going to sign your loan estimate tomorrow, or even today, or next week, you will be like, I know what's going on, and you will sign with, like, after you read all the number, you know exactly what you paying for, who you pay to. You will be a very different real estate investor starting today. I'm so glad you did what you just did. And by the way, congratulations, you did your quiz awesome. You did it. You did all. You selected all the correct answer. Congratulations. And I'm gonna see you in module 2. After you're done with module 2, you will be another level of confidence, and then I would know you will enjoy the journey of real estate investment. And I wish you well. I'll see you in module 2. Hello, welcome to module 2, lesson 1. Again, you just finished module 1, which is really long and it's so much new information to you. Module 2 will be easier for you because you have all the knowledge you need from module 1. Now you bring it to module 2. After you're done with module 2, you will kind of memorize all the numbers, all the charges, all the fees. You kind of know, okay, there are loan costs and there are other costs, and the loan costs have this section, this section, this section, this section, and then the other costs have this sections. So you will so like confident, know everything about real estate loan document, right? You feel so confident and awesome right now, and then you will feel more confident and more awesome after you finish module 2. So I can't wait to see you in module 2. See you later. Hello, welcome to module 2, lesson 2. We're gonna learn about CD. What is CD? CD stands for closing disclosure. When do we receive a CD? Remember when we learned in module 1, we receive a loan estimate 3 days after lender receive our loan application. That when we just submitted our loan application. So the LE was issued at the very beginning of the loan process, right? But the CD will issue by lender at the very end of the process after we lock our interest rate and we are about to sign our final loan documents, okay? So the CD will show the final interest rate if we don't want to change the rate anymore. So final interest rate, and now you know your monthly mortgage payment, okay? So let me read the definition of the CD for you. CD provide final details about the mortgage you are applying for. It includes the loan terms, your protected monthly payments, and how much you will pay in fees and other costs to get your mortgage. The lender is required to give you the CD at least 3 business days before you close on the mortgage loan. This 3 days window allows you time to compare your final terms and costs to those estimated in the loan estimate that you previously received, and to ask any question before you sign your final loan documents. You won't receive CD if you are applying for a reverse mortgage. So, okay, let's explain what I just read to you. So when you receive a CD, you have 3 days, and that 3 days you can look at all the numbers in the CD and compare the CD to the numbers in the loan estimate to see any different. Most of the time the difference is the interest rate, because now you lock in the interest rate. The CD is where you haven't locked in the interest rate. Now you lock in the interest rate, now you have the CD. And this 3 days you have all that time, you can ask question, any question you can ask your loan agent, anything about the CD before you sign. So this 3 days is the day you receive the CD, you acknowledge you receive it, and it have to be 3 days before you sign your final loan documents. So you have that 3 days window, okay, to decide on whatever you want to do with it. And you can even cancel the loan if you don't want to go forward, okay? Now we talk about the reverse mortgage. We don't receive CD. What is the reverse mortgage? Normally when you borrow a mortgage and you making your monthly mortgage payment, it's called a forward mortgage, because you borrow money, you pay back every month. That's forward mortgage. Reverse mortgage is for people who are over 62 years old, and they qualify for that mortgage. It's called reverse mortgage because they don't see themselves paying the monthly mortgage. Instead, their mortgage, the principal of their mortgage getting bigger and bigger by time because the interest adding up into the loan itself. Okay, so but when you do reverse mortgage, you don't receive a CD, but instead you receive a HUD and the truth in lending. That's something else. We don't talk about it here. But go back to the CD. CD is another form, the disclosure form that's sent out to you so that you can read, you can ask questions before you sign your final loan docs. Now we're gonna look at the CD. Okay, we look at the CD, how it looks. First page of the CD would look so much like the first page of the loan estimate. It's like almost the same. It's so similar. It's like no different. But page 2 a little bit different. But in this case, now you see the loan amount is the same, 330,000, but the rate now is 4.375%. Remember, in the loan estimate, the rate was 4.875, but now the rate is 4.375. It's much better, right? When I do a loan for my client, most of the time, my LEs is higher than our CD because I'm a conservative type. I give people the higher number because I want to make sure that they are approved with that interest rate, and then when they lock in the lower interest rate, they overqualify. I don't want to disclose as a low interest rate and then later on lock them in at a high interest rate that might affect the qualification of the borrower. So that's how I do my business. I always disclose very conservative, and then when I finalize lock in the rate, I lock them at the better rates. Okay, so now the monthly principal and interest payment or the monthly mortgage payment is lower. It's only $1,647, not $1,700. You see this? Again, this loan have a prepayment penalty. Okay, it said if you pay off the loan during the first 4 years, if the client in this particular loan, not every loan have the prepayment penalty, but this particular loan, my client applying for a 4-year prepayment penalty, meaning that she had to keep this loan for 4 years before she want to refinance or sell the home. If she refinance before 4 years or sell the home before 4 years, she had to pay prepayment penalty, and it's the highest is $13,200 is the prepayment penalty. And you see the rest look exactly the same, but also here you see the closing cost now is $15,535.35, not $14,885, because remember the loan estimate showed the closing cost $14,885 because it's an estimate, and now the CD is close to the final number, and now it's $15,535. You might say, wait a minute, why the closing disclosure, the closing cost is higher? Think about it. Think about the interest rate. Whenever the interest rate is higher, you pay less, and then when the interest rate is lower, you pay more. So in this case, because now my client locked in the interest rate, lower interest rate, so she had to pay a little bit more on something. That's why her closing cost is higher. To find out why the closing cost is higher than that it show in the loan estimate, where are we gonna look for? We're gonna look in the page 2 of the closing disclosure. Okay, we're gonna go over there. So in page 2 of the closing disclosure, I will show you why this number is higher than the number in the loan estimate. And look, but the cash to close, look at this. The cash to close is $122,000. It's so funny, right? The closing cost is higher, but then the cash to close is lower. Remember, the cash to close in the loan estimate is over $123,000. It was $123,260. And here in the closing disclosure, the cash to close is only $122,475. So most of the time, again, when I disclose my loan estimate, I disclose higher number to be conservative, to make sure my client That's the maximum they have to pay for. But when the closing disclosure, the number go down. Everyone is happy. Me, I'm so happy, right? Now we done with pay 1 of the closing disclosure. Let's go to pay 2 to find out why the closing cost and the cash to close are different. Okay, let's look at them together. Okay, let's take a look here. Okay, we have pay 2 of the closing disclosure. Their format is very different, and you see in the loan estimate, the loan cost is on one side, and then the other cost in the other side, and 2 columns side by side. But in the closing disclosure pay 2, the loan cost section is on top of the other costs. So they just the layout different, okay? But everything else should be the same. And we also gonna break them out into section A, B, C, D, E, F, G, H, I, all the numbers still the same. Let's see what is next. We have page 3 of closing disclosure. Again, this page is a summary of page 1 and 2. Okay. Now the most important page is page number 2. Now let's go to the breakdown. I break down this. See, I cut the top part of page number 2 and the bottom part of page number 2 of the closing disclosure, and I put them side by side. So now they look like the loan estimate, okay, because I just cut them up and I put them together. So you will see I also break these 2 columns into smaller section. Remember? A, B, C, and D. And now if you look at section A, remember in the loan estimate, you only see 2 numbers in the section A. You only see the loan origination fee and the underwriting fee. But in the closing disclosure, you see 1 more fee. What do you see? You tell me. In section A, do you see another fee? How much is it? $825, right? And what is that fee? I know you know the answer. It is the discount point. Remember now, the client locked in the rate $4.375%. It's a lot lower than the 4.875. And in order for the client to lock in the rate of 4.375, she had to pay the discount point. Remember the definition of the discount point? Discount point is paid to lower the interest rate. You see that? And this client paying $825 to lower her interest rate. This is awesome, right? So when we add all the number in section A together, we have the total number, and that is A. When we look at section B, all the number are exactly the same from the loan estimate. No different. In here, actually, beside the appraisal fee, credit report fee, flirt cert, tax service fee, now actually there are 2 different numbers come into the closing disclosure at this point. Do you see something different here? I saw the evidence of insurance $150 and the HOA certificate fee of $350. So at this point, lender add 2 more fee into it, and evidence of insurance. This is it about insurance. It's not the lender fee. It's about insurance, so it's okay to put in an HOA certification. So $350 is also not lender fee. So this home have an HOA, so the client have to pay HOA association fee. So this section B is different from the section B from the loan estimate. So now section B is the total number is higher than the section B in the loan estimate, right? And then section C, we have all the number the same. In this section, nothing changed, I guess. And we add them up together, we have the C. So D again equal to A plus B plus C. All right. and it is equal to $11,997.30. That's section D. Okay, I remember in loan estimate, section D is 11,090 something dollars. So this is like $800 more. So in this section D, the number is higher compared to the loan estimate. Now we go to the other cost. We also do the same thing. We will add all the number in section E. We have the total number is E. We add all the number in section F. We have the total number is F, and then G is still 0. H, oh, look at the H here is a lot lower. I remember the previous loan estimate. It showed $1,441 for the owner title policy, but now because it close to the end, everything had to be exact or close to the number that the buyer had to pay. So the correct number is 667. So a lot of time the loan estimate have a higher number because lender and mortgage broker want to be conservative. Now when we add E, F, G, and H together, the total come out $3,538.35. It lower. I remember the I total in loan estimate is like $3,780 something dollars, but here is only $3,500. So now we have the total of other cost and we have the total of loan cost. When we add them together, we have J, and J is $15,535.65. So in this case, this number is exactly the number shown on page 1 of the closing disclosure of the CD. You remember this number? You see that number before you see this screen. So now you are able to explain to yourself why $15,535.65, right? So I hope that you was able to follow, because it's actually exactly the same way of calculating all the number and break them down into section A, B, C, D, E, F, G, H, I, J. It's exactly the same way. The only difference is there are some different numbers and more coming into the CD, because this is the very final stage where it's very close to where you sign your loan document. Okay, so those are the numbers that's very close to where you have to pay for your loan application, right? So you are now done with lesson number 2 of the module 2, and I will see you in the next section. We're gonna talk about something new, but it also within the closing disclosure. So see you soon. Bye now. Hello, let's start our next lesson. Lesson 3, module 2. What is lender credits? Are you interested about something credit? Something credits mean you get it. You don't pay for it, you get it. We've been talking about all the number that the buyers or the borrower have to pay. Now we talk about something the borrower got to get. Okay, it's a credits. That means borrower get it. Okay, so lender credits is it's a money that lender offer the borrowers or the buyers because the interest rate that the borrower lock at, and they can use this lender credit to pay for their closing costs, but it cannot bring it home. Okay, the lender credits can be used to pay for closing costs, but not to bring home. Okay, so I'm gonna give you example so that it's easier to understand. Instead of reading you the definition, you can read the definition, but it's easier to explain it. And look at the other cost. At the very bottom, you see I circle in red. You see lender credits, and in this case, there is no lender credits at all. Why? when the client want the lower interest rate, and she in this case decided to pay for the mortgage discount point. Remember, $825 mortgage discount point she paid. Whenever she choose to get a lower interest rate and pay for discount point, there is no lender credits. Lender credits and discount point, you won't see them together in one disclosure. In one closing disclosure. You either see the discount point showing, or you see the lender credit showing. You don't see two things in one closing disclosure. Let me give you an example. At 4.375% interest rate for a 30-year fix, in this case, the client had to pay for discount point $825. If the client said, I don't want to pay for discount point, I'd rather have a higher interest rate and pay no discount point, then lender offer 4.5% interest rate. Okay, but some borrower said, I want some credit from lenders to help me to cover my closing costs, some of it. Then the lender will say, okay, how about 4.625% interest rate, and I will credit you $1,000, just to make an example, right? So if the client select the rate of 4.625, she will get a $1,000 lender credits, and she can use this 1,000 lender credits to pay for some of her closing costs. Not all, because only 1,000, right? If somebody said, I want a lot of lender credits, like 3,000, then her rate might be 5%. I don't know. Just give you an example. So lender credits, you get lender credits when you accept the higher interest rate. And when you don't want higher rates, you never get a lender credits. When people do a no point, no cost loans, meaning the client have to accept higher interest rate, that rate will cover all the points and costs. That means lender give you all the money to pay for your points and your costs. That when you do no point, no cost loan, lender paid for you, but then in return you have to accept higher interest rate. That's how you get a no point, no cost loan. Okay, so we are, oh my goodness, we're done with lesson 3 of module 2. Congratulations, you are wonderful. I admire you for working so hard with me, and I really enjoy working with you, and I hope to see you in my next lesson. See you soon. Hello, I'm so glad to see you in this lesson. And good news, we don't have to learn any new concept now in this lesson. Instead, we're gonna take a quiz. And in this quiz, it's only 3 questions, and I hope you will enjoy doing it, because the whole purpose of creating the quiz for you is to make sure you remember what you learned, and I want you to have some fun doing the quiz. I hope you enjoy doing it, because the whole point is happy learning, happy growing. Okay, so please take the quiz and finish it and feel awesome about yourself, because you deserve to feel awesome, to feel good, feel really good about yourself, because you already done up to this point. You know, you are really an achiever. You are great. I want to see you in the next lesson soon. Hello, welcome to lesson number 5, module 2. This is gonna be interesting, because we're gonna answer a very, very frequently asked questions, and it's really important when it comes to making decision on what to do when you lock your interest rate. Every time I talk to my client about rate, they ask me this question a lot. So I want to talk to you about it, so you can answer the question by yourself. Okay, you don't need anyone to answer it for you. Okay, so the question is, do I really save money if I pay for discount point to get a lower interest rate? Okay, let's look at the situation that we just seen. My client who locked the rate at 4.375% interest rate for 30-year fixed, and she paid $825 discount point. Is she does she benefit from paying the $825? In order to do that, we will have to say, okay, if she doesn't pay point, for example, if she locked the rate at 4.5%, no discount point, because when she lock higher rate, she doesn't have to pay discount point. And if she locked the rate at 4.5%, her monthly mortgage is $1,672. If she locked the rate at 4.375, her monthly mortgage is $1,648. So the difference between the two interest rate is $24 a month. Okay, so $24 difference. If she pay $825 discount point, she saved $24 a month on her monthly mortgage payment. Okay, let's take $825 discount point divided by $24 saving. It will be, I remember it's going to be 34 months. That means 2 years and 9 months. So it takes her 2 years and 9 months to recover $825, because she want to pay $825 upfront to save $24 a month. So in order to recover that amount, it takes her 2 years, 9 months. Okay, does she benefit? Yes, she does, because this loan, remember, she had to keep it for 4 years. If she planned to pay it off within 4 years, or sell the home within 4 years, she had to pay prepayment penalty. But because she knows she's gonna keep this loan for more than 4 years, so she decided to lock in the rate where she paid $825 for discount point, because after 2 years and 9 months, she continued saving $24. So she is definitely benefiting from paying the discount point. If she pay off the loan within 2 years, or she sell the home within 2 years, she doesn't benefit from paying the discount point, but she lost her money in so many ways. She lost her money because she not even recover her discount point, $825, and she had to pay for her prepayment penalty. But in this case, she knows in advance she will keep this loan for more than 4 years, so she decided to pay for the mortgage, the discount point, to lower her mortgage payment by $24. So she does benefit for this case when she decides to pay for her discount point. Okay, so from this one, it lead to the next question. Should I take no point, no cost loan option? So the same thing. If you are doing the loan every 6 months, if you refinance every time you see the interest rate going down, or whatever purpose that you keep refinancing your home, then you definitely want to do a no point, no cost loan. Because if you pay for point and cost, or you pay for discount point, and you refinance so soon, you will lose. You don't benefit at all. So when you keep refinancing, then you should do a no point, no cost loan. But if you think you are gonna keep your loan for a long time, that you won't do anything, if you keep it for more than 2 years, 3 years, or you will keep it forever, then you should pay some discount point to lower your monthly payment to save you money, so that when you benefit from when you keep the loan long, you pay for the discount point. That's when you benefit from it. But if you don't keep the loan long, if you just keep refinance yourself so many times every year, then do the no point, no cost loan. Okay, now you can answer two very important questions. Again, the discount point is good when you keep the loan for a long time. When you decide to pay for the discount point, you keep the loan for a very long time. But when you keep refinancing your loan, or you sell your home in a short year, like 1 year, 2 years, or 6 months, then it's okay to do a no point, no cost loan. It's completely fine with that. Okay, the next question is, who pay for appraisal report and credit report? Most of the time, or all the time, the buyer or the borrower who borrow a mortgage pay for appraisal fee and the credit report fee, because those are the fee paying to a company that provide the service, the appraisal service and the credit report service. So that is what you're supposed to pay for. So you are now complete your lesson number 5. Oh my goodness, I'm so happy for you because you did so well. You are all the way here. You can answer very, very frequently asked question where people don't know how to answer this, and you do now. You can go and help your friends, your family, anyone. Okay, so congratulations, you finished module 2 and lesson number 5. I'll see you in module number 3, and module number 3 will be something totally different, but it also very, very awesome to learn. So I can't wait to see you in there, and you will see this, the next document. It calls settlement statement, every single real estate transaction. Okay, I'll see you there. Hello, welcome to a very interesting, very different module and lesson. Let's look at the settlement statement. You see, this form is completely different from the loan estimate and not the same as the closing disclosure at all. As you see, it kind of look a little bit too much to read, right? Because everything is shrinked into one page. Okay, I'm gonna tell you my own story. Remember, I bought my home in 2000. I remember that myself. And when I signed my final loan document, I was really scared because I didn't know what I signed myself into. Honestly, I saw this form, I didn't know how to read it. I don't understand anything, and all the numbers look like, I don't know, scary to me. They look scary. There's so many numbers, and I don't even know how to read it. Should I read it from left to right, from right to left, from up top to down, up to bottom? I don't know. I didn't know. I don't even know how to read it. How do I read? I couldn't read it though. I was scared, and I wished somebody there to teach me how to read it, right? But I could not get that help at that time. So I think when I created this course, my whole purpose is I don't want to have any more buyers feeling the way I felt back then. I want everybody to feel happy buying their home, happy investing their properties, okay, real estate. I want everybody to be happy when they invest in real estate, have good experience, not scared or lost like I did, okay? Here you go. This is the settlement statement. The first section is more like just general information, so you can read it yourself. But starting from this section down, it's very technical, and I will show you how to read it. You will read. Okay, you have to divide it into section. Remember, you have to take piece of, again, the same way we eat the cake I talked earlier. We need to eat one piece at a time, not the whole piece and put it in our mouth. It's so hard to eat like that. So same thing when you read document, you need to divide them into section. And in this settlement statement, I want you to divide the column. So the first column is seller, okay? Seller column. And then the middle column is description, and the last column is the buyer. So you will see in the seller column, there are two smaller columns. It have debit and it have credit, right? And also in the buyer column, we also have two columns underneath. It's also debit and credit. Let's go over the seller first. In the seller column, look at this one. You see 440,000 in the credit column, and that show the sale price. How do you find out the sale price? Look into the middle column, the description. So 440,000 is the sale price. You see the number 440, and next to it is the sale price. That's the description. So you have to read the column from the seller side and the middle description column to know what kind of fee it is. What is that number? Okay, that's the sale price. And then underneath the debit column, you see $560. And what are they? The fixed $560 is the county tax, paying to the county. Okay, and now that is the seller column. And look at the buyer column. Now we look at the buyer column. This is where you want to look. Okay, I just show you how to look at the buyer seller side, just an idea of how to read it. You don't need to worry about the seller side. You need to worry about the buyer side if you're the buyer, right? And the seller column is really simple, so it's easier. But debit and credits, debit mean the buyer have to pay for it. Credit mean the buyer already get it from somewhere or from his own money, right? Let me explain it in detail when it comes to number. So you see, again, in the debit column, it have a 440,000. That's the purchase price that the buyer have to pay for the house. 440, that's the amount the buyer had to pay for the house. That's the home price, the purchase price. And you go all the way down. I'm still looking at the debit column. I don't look at the credit at all. You see the prepaid interest of $1,278. This prepaid interest is the interest the borrower, the buyer, paying to the lender for the mortgage that he or she borrowed. Okay? And then now the rest of the number in the debit columns are exactly the same number that you see in the closing disclosure in the CD. So I don't want to go over every number here because I don't want to repeat them. They are exactly the same number in the CD. If you want, you can compare. You can print out the CD and compare side by side with the settlement statement. You see all the number here is exactly the same number in this closing disclosure. Okay? So that the debit column. Let's go to the credit column. The credit column, you see 2,500. What is this? That the deposit that the borrower paying to bringing to the title company on May 25th. Okay, and you see the next number is 330,000. That is the loan amount. You see the loan amount. When you want to know what that number is, you have to look into the middle column where the description of every number is there. And then underneath there is $560, the county tax. You see the county tax $560, the seller paying and the borrower receiving, the buyer receiving. Why is this? Because if you look at this, the county tax from in the middle column, you see the description. The county tax $560 paying for July 1st, 2021 to September 1st, 2021. Look, the buyer had to pay this amount when he's not even living in the home yet, because the buyer is not going to move into the home until after September 1st. But the seller is still living in the home, because the seller is still living in the home from July 1st to September 1st. The seller is supposed to pay for that amount, not the buyer. So the seller, $560 under the debit, that means the seller paying for it, and the client, the buyer, receiving this amount. Why? Because later on, when the buyer had to pay the 6-month property tax, he or she will have to pay the total amount of 6 months, and that 6 months includes this July 1st to September 1st. So right now, the buyer received that money from the seller, holding it in his hand, and wait until later on when he had to pay for his property tax 6 months. He will use this money together with the amount that he had to pay for himself, put them together and pay to the county at that time. So that's why right now the seller paid that amount to the buyer, so the buyer hold it there and pay for the county later. You see that? That's why one paying it at the debit and one receive it at the credits. So now we have page, the next page of the, because it's not showing the whole entire page here. This one is the continuation of the previous page. Continue looking at the buyer column in the debit. You will see all the recording fee there. It's also matching with the closing disclosure, but in this settlement statement, they break down the number. In the closing disclosure, you see only one number of recording fee, but in the settlement statement, you see them breaking down into individual number. But they are about the same number or less, right? And you see the transfer tax, it's the same exactly amount. One more different thing you see in this settlement statement, but you didn't see in the closing disclosure, is the home insurance. I yellow highlighted $420. That's the home insurance that you did not see in the closing disclosure. So for this settlement statement, you will add all the number in the debit column together. It come out $453,638. And then you will add all the credit column together. It's $333,060. The difference will be how much the buyer have to bring in. So when after you add up all the debits column together and you add up all the credit column together, and the difference is the amount the buyer have to bring in at the cash to close. In this case, $120,578. And this is less. This amount is less than the amount showing in the closing disclosure. I think you can go back and compare this number with the closing disclosure. The whole point is the settlement statement. All the numbers are very similar to the closing disclosure that you see previously. Okay, so I know this section also have a lot of information, have a lot of number, but make it simple. In order to understand this, you break the form into columns and you read them into column. If you are the seller, you look at the column, the seller column, you add all the debit number together and you add all the credit number together, and you will see the difference. And you know the difference, either the client had to bring in or you have to pay something. And then the middle column, the description column, is the description of all the number involving in the two column of the buyer and the seller. And if you are the buyer, you're looking at the buyer columns, and underneath the buyer columns there is debit columns and there is credit columns. A debit columns is where the buyer has to pay, and the credit columns is the money from the loan from the lenders or the deposit that the buyer brought in at the beginning of the process, or some credit from the seller, that where you see the credits. And in order to calculate them, you had to add them separately. So all the number in the debit column, we can add them up together to get the total number. And in the credit column, you have to add all the number together to get the total credits. And the difference will be how much cash the buyer have to bring in for the down payment and the closing cost to pay to the seller and the title company to complete the purchase transaction. If you have any concern or question, how you want me to improve the course, please give me some comments so I can create a better course for you. I can make it more clear for you if you give me your feedbacks. I can't wait to see your feedback, and I look forward to see you in the next lesson. You almost there, just a little bit more, you will be done. You will be done very soon. You are already done with lesson number 2 of module 3. I'll see you in the next lesson. Hello, welcome to module number 3. I'm so glad to see you in this module. Not many people get to this far, but you do. You are so awesome. You will learn about the settlement statement in this module. And I'm telling you, even a professional, a loan agent, a mortgage processor, or or realtor, they either can read the settlement statement and comfortable with it, or they can only read the closing disclosure. They choose one form to read. They don't read all the forms because it looks very different from this form. But I'm so glad you show up to learn the settlement statement, because you're gonna see this form in every real estate transaction. Okay, so I'm so glad you're here, and let's go to the next lesson to learn how it looks like and how to read it, okay? Hello, let's do lesson number 3. Again, there is no new concept in this lesson. It's about the quiz. Before we take the quiz, I just want to let you know that the settlement statement is only created by the escrow officer. So you remember that we work with the title company, escrow company. Those are the company that protect the consumer, which are the buyers, right? And the escrow officer is the one who do all the paperwork, and that person is the one who created or prepare the settlement statement. Who create or issue the loan estimate and the closing disclosure? Lenders. Lender generated the loan estimate and the closing disclosure, but escrow officer is the one who created the settlement statement. And remember why you had to learn loan estimate and closing disclosure, because all the number in the loan estimate should show up in the closing disclosure, and all the number in the closing disclosure should show up in your settlement statement. Remember, we look at the settlement statement, right? All the closing disclosure numbers show up in the settlement statements. Remember that. And there are only 3 questions for your quiz, and I know you're gonna do well on the quiz. I know you will pick all the correct answer. I can't wait to see your quiz result, and I know you're gonna get 100%. I can't wait to see you in the next lesson. Take care. One more, just one more là done. Okay, one more, that's almost done. Hello, my goodness, you already done almost all the lesson in module 3, and this is your last lesson. And actually it's not a lesson, it's just a section where I want to wish you well. I congratulate you on completing all the lesson, all the modules, and I hope that you will be very successful in anything you do, because you are a great achiever. You register for this class and you are all the way to the last lesson. Not many people get to where you are, but you do. I congratulate you for being such a wonderful person. You do what you said you do. You commit to whatever you want to do. My passion is real estate, and I hope learning whatever you learn from this course will make you become one of the person who have passion in real estate as well, because knowing real estate investment is one of the wonderful investment in the world that will help people to become rich and retire early. And I wish you to become very rich and retire early too. Let's do it again. I'm so happy since you complete all 3 modules and you get to this point. You are definitely a great and I have to turn this off. I mean, how to create. Em chị xong rồi em dừng lại để chị làm cái không, dừng cái này lại để chị go cái next one. Hello, congratulations, you completed all 3 modules. You are such a wonderful achiever. Not everybody do what they say to do, but you do. And I know you will be successful in anything you do because you commit to whatever you say. That's so wonderful, so awesome. And I wish you to be very successful in real estate investment, And you know what? I'm a real estate investor, real estate agent, and a loan agent. And my passion is real estate investment. And I hope the more you learn about real estate, the more you become passionate about real estate. And I can't wait to see your success. And real estate investment will make you become rich and you have a chance to retire early. And I wish you well. I hope you retire early. And if you have any question or you have any concern that you want me to help you with real estate, please, email me, let me know. I care. I do care. I love to see your success. So please let me know, email me, or give me any feedback how I can do the course better for you and everybody who learn it. And I can't wait to see you in my future courses because I'm gonna create more classes or courses for you to learn if you are interested. Thank you so much. I'll see you soon. Bye bye.